Tale as old as time, an entrepreneur needs money for their business. Today, we're going to talk about different types of capital, and if you decide to raise equity, what that process looks like, what the different types are, and pros and cons of each. First of all, what are the different types of funding? Well, it's not just raising money from venture capitalists. In fact, you might be surprised to know that less than 3% of all businesses raise money from venture capitalists. It's a really small percentage. And in fact, some of the largest businesses in the world today, you think about like Procter & Gamble, never raised venture capital. And yet they have established themselves as these huge behemoths in the industry. So definitely not necessary to raise venture capital. In fact, don't even have to raise equity. The other two forms are debt, so you could go borrow money. In fact, it's very common for entrepreneurs to max out those credit cards or take out a home equity loan on their house in order to start their company, basically starting it with debt. That's one way to do it for sure. And then the other way to do it is with grants. You might be surprised to know that there are a lot of grants available, particularly if you're starting anything science related. There are a lot of grants that are available from the government, from nonprofits, and from others that are looking to support small businesses. So seek out those grant funding opportunities. Going back to debt, there's also what are called Small Business Administration loans, so SBA loans, that you can qualify for to help build your business as well. Now, they do require a personal guarantee, but definitely something worth looking into to help grow your business. In addition, there have also been, if you have more of a technology type startup and you are looking to raise venture capital, from a debt perspective, you can raise money from venture debt funds like Silicon Valley Bank. You can also raise money through credit lines, credit facilities. There are a bunch of other companies that are now providing different credit lines for small businesses like Ramp, like Divvy, like Brex, where you can get a credit line without having to have a personal guarantee based on the cash flows or the revenues of your business. And lastly, if you have a subscription side of your business, there's some really interesting financing partners out there that will actually finance the subscriptions. A really innovative solution to that is a company called Pipe. And if you have subscription revenue, they will lend against that subscription revenue at a rate that's much cheaper than what you would pay ultimately for equity and for most forms of other debt. Ultimately, though, debt investors are always going to be somewhat risk averse. And if you really want to take your company to the next level, you probably need to raise equity. And if you're going to pursue a high-paced, fast growth, shoot for the moon startup, then venture capital is probably the way to go. But you don't just start with venture capital day one. Let's talk through the different steps. So step one is your personal money. Most entrepreneurs are going to start with some amount of their own money. Now, oftentimes they're maxing out credit cards, which I don't know that I would recommend, but it happens all the time. They will mortgage their house. They'll have their savings that they use. Could be all kinds of different things. The founder of Peloton famously pulled 200 grand from his 401k to start Peloton. And after taking the hit on the taxes and everything else, it ended up being an even smaller amount. But that's what it took to get Peloton off the ground. And for him, that was an investment well worth it, right? So the first step is your personal money. You want to show that you've got skin in the game to investors. The next pool of capital is what we lovingly call the 3 Fs. Your friends, your families, and fools. Now, the 3 Fs are important because these are people that are investing in your business because of you. Not because of your idea or how cool it is or whatever. They trust and love you, and that is why they're putting in that money at the very, very early stages. So could be friendly family, could be friends, close friends, could be friends of friends and other investors, and those are the ones we lovingly refer to as our fools. Either way, that should give you enough money with your own personal money to actually start building a minimum viable product. Now, a minimum viable product is simply a product that's as basic as it can be, but still solve the core pain point for your customer so that you can go out and start demonstrating that you are solving a real pain point for somebody. It could be, even just designs of a product that you are able to put on a website and start collecting data around who would actually buy it and then, refunding their money once they try to buy. It could be all kinds of different things, but thinking through how do you demonstrate to potential investors that you have a product and a business that's worth funding. Because your next level is to go to angels. Now, angel investors are typically individuals that have been entrepreneurs themselves, and they've seen some level of success in their career. And at this point, usually they're retired and they are seeking to give back to others. Angel investors could also be other successful entrepreneurs that are still running their business or running another business. They could be very successful executives at some large companies. Sometimes they'll put money in as well. And good angel investments can help take that MVP from, something on the back of a napkin or images on a website into a full-fledged product that you can start selling. At that point, you'll start thinking about venture capital. Now, venture capital starts spanning a lot of different categories. But when I talk about venture capital, I'm referring to what we call as institutional investors. Now, an institutional investor is somebody that, unlike an angel who's investing their own money, an institutional investor is investing somebody else's money. And so that can be as early as like a seed stage fund, where you have a manager, an investor that goes out and raises money from a bunch of people to invest in his or her seed fund. And then he or she goes and invests in these startups at the seed stage. Now, the seed stage, you are just trying to finalize your product and you're trying to achieve what's called product market fit. So think about it this way. Your personal money, your friends and family money, your angel money, that is all to build the product. All of that is considered pre-seed capital. Seed stage capital, your goal is to take that product and achieve what we call product market fit. Now, the idea behind product market fit is that you are able to demonstrate the product that you have is solving a major pain point for the market, such that the market starts to pull on you to sell more of your product. In my book, that's how you know you've achieved product market fit, is when you don't have to push so hard, you start to feel it pull away from you, right? You start to feel customers start demanding the product and pulling on it. So that's step one, but step two is it's got to be a big enough market that people actually care. So if you're solving a need for just one customer and they really want that product and they're willing to pay whatever, but they're the only ones that want that product, you haven't really achieved product market fit. You've achieved it, but just for that one customer. You've achieved like product customer fit. But what you want is broad product market fit. So you have lots of customers coming to you and demanding the product. And you'll see this in like strong word of mouth and other things that start kind of pulling on you, right? Once you've achieved that, then you go to traditional venture capitalists and raise what we call a Series A round of funding. Now, traditionally, this was your first institutional round of funding, but really what it's become today is this delineation between pre-product market fit and post-product market fit. And most investors are going to be looking for somewhere between $1 and $3 million of revenue from a broad base of customers, not just like a couple big ones, but a broad base, in order to demonstrate, yeah, you've achieved product market fit. And now you don't need to keep searching in the wilderness for your market. Now you can focus on growing the business. So the capital from your Series A investors can be used to help figure out your marketing strategy. Because up until this point, you probably have tried a lot of things, but now you need to formalize it. Maybe it is you need to go out and hire a bunch of sales reps, and you need to build like an institutionalized marketing process and sales process and so on and so forth, and take it from a startup trying to find a solution to a problem to now a company that is trying to deliver that solution to as many customers as possible. Once you've figured out your sales motion, or your marketing motion as we call it in the industry, how you're going to sell this product essentially and do it cost effectively and repeatably, then you raise your Series B round, and all subsequent rounds for the most part are about putting more capital, more fuel on that fire and helping you grow your business and scale it rapidly. That segment is what we call growth equity, where the focus isn't so much on like seed stage, where it's like, hey, how do we get product market fit? Or Series A, which is how do we bridge this chasm from product market fit into high growth? It's really then focused on how do we continue the growth and acquire as much market share as possible so we can demonstrate and establish ourselves as a leader in the space. Eventually, if that growth equity is successful, then the company will grow and grow and grow, and hopefully it'll eventually either go public, wherein it will raise money from public investors and be traded freely on an exchange like the New York Stock Exchange or the NASDAQ, or They could be acquired by another larger strategic, or in many cases by a private equity fund. We were an investor in a company called Instructure, which if you've gone to school, if you've attended university in the last few years, you're probably familiar with the product Canvas. We invested basically at the very early stages when there were just 20 employees. We watched it grow all the way up to, I think, over 1,000 employees. They went public. After going public, Instructure was then acquired by a large private equity firm called Thoma Bravo. And Thoma Bravo has come in and bought the company, taken them private. They own the whole business, essentially, and they're using the private equity playbook to make money off of that business. So you can see how there's this interesting cycle for most startup companies that ultimately are successful. They start out with this idea that the founders have. They put their own skin in the game, invest their own money. They convince their friends and family to get around them. They go and get really strategic and thoughtful and helpful individuals to invest. They then take that money, they figure out how to really solve a true pain point in the market. And once they've demonstrated that, they then layer on capital to grow and acquire market share as quickly as they can to the point they eventually can go public or get acquired. So hopefully that's a helpful overview of the entire life cycle of how funding works and at what point each of these investors play a role. If this video is helpful and you want to learn more about the fundraising process, check out my other video where I talk about what you should expect when raising money from a venture capitalist.